What are the rights that corporate shareholders have? Well, they have voting rights. If you have one share of stock, unless there's some strange situation, you have one vote. Shareholders have the right to vote on the election or removal of directors and on fundamental changes to the corporation, such as dissolution, right? You don't want your investment to go just get dissolved. Voting allocation, typically each share of stock is entitled to one vote unless there's something different going on. And then cumulative voting. So the articles can grant shareholders the right to cumulative voting, allowing them to allocate their votes in any matter, such as casting all votes for a single candidate. This benefits minority shareholders by increasing their chances of board representation. Not too much importance here. Focus on more so just the general points of how this works. Dividends, super important because as the owners of a corporation, we get taxed on those dividends. Lots of important points with this. Now, distributions, shareholders do not have the right to distributions such as cash dividends or the repurchase of shares unless declared by the board of directors. So that's totally fair. Whether it's Apple or Disney or any sort of company, even if they've distributed dividends for 100 years, that you technically don't have the right to dividends. That's up to the board of directors to declare the dividends. Now, like I said, it makes business sense to be consistent in your payment of dividends. So that's why you'd see maybe a 50-year history of consistent dividends being paid. Once a distribution is declared, shareholders are considered unsecured creditors to the extent of the dividend, and distributions reduce the corporation's shareholders' equity. Now, for unsecured creditors, when a dividend is declared by the board of directors, shareholders become unsecured creditors of the corporation to the extent of the dividend. That gets important when we deal with bankruptcy. This means that in the event of a corporate bankruptcy or liquidation, they will be in line for the payment after secured creditors, but before equity holders. There's a whole line of who is first, who's second, who's third when it comes to bankruptcy and distributing the assets of a bankrupt entity. And like we have with many other topics, we have a whole lesson on that for sure. Varying distribution rights. A corporation can create different classes of shares with varying distribution rights. This allows the corporation to prioritize certain shareholders for dividends or other distributions. Preferred stock is actually much more like debt than it is like equity. And if you've taken any of the other exams with us, I beat that to death in those ones as well. Preferred stock, you get a paid amount. So instead of the board of directors having to declare a dividend, preferred stock, you know what you're getting each year, kind of like interest, and that you're paid out before the common stockholders. Now, generally, you don't get to vote with that preferred stock, but it's just another type of financing. When would you see that? A great example being 2008 financial crisis. Bank of America is not doing too well. Everyone wants Warren Buffett's money because he's got a lot of money at that point. And a lot of the banks are trying to incentivize him to invest in their banks so they don't go under. He declares that he wants preferred stock, which is going to be more preferential than common stock from Bank of America. And it essentially, I'm not privy to the exact terms of it off the top of my head, but let's say you had 1,000 shares, $100 each with a 5% dividend, and it would be called a 5% dividend there, and you get that every year. That is cumulative. If they decide not to pay it out, he's still entitled to it. It racks up over time. And then whenever there's a dividend declared by the board of directors, that gets paid out. Preferred stock, not really tested on this exam, but just for your information. Here are a couple other options for dividends from shareholders. So what's important here to note is when you receive an asset from a corporation, generally it's going to be some sort of dividend, as we see here by the title. And each of these have very different tax treatments. Well, also it's a date. We've got stock dividends. It's different than a cash dividend. So let's talk about these specifics. First off, preferred shares. These shares typically have a preference in receiving dividends. So think about it, kind of the example I gave with the Warren Buffett example, or you could think about it as well. Someone could just buy preferred shares instead of common shares. They're entitled to a fixed dividend amount before any distributions can be made to non-preferred, also known as common shares. Cumulative for preferred shares, if a dividend is not declared in a particular year, again, it's kind of as I was mentioning, the right to receive the preference accumulates. Now, all accumulated dividends must be paid to cumulative preferred shareholders before any dividends can be paid to common shareholders. Dividend declaration. It's going to be important to remember that dividends are not due until declared by the board of directors. They are not owed to you. You have no rights to that until the board of directors declares that they are paying out dividends. And then stock dividends. These are issued from a corporation's authorized but unissued shares. Think of it like their treasury shares. Think of it like they are taking them from their vault. They are minting these shares and putting them out in the market. Now, these dilute the amount of shares outstanding because they're creating more shares. and giving existing shareholders more shares instead of giving them cash. Stock dividends do not involve the distribution of corporate assets, so they do not affect the corporation's solvency or the shareholders' or creditors' interests. Additionally, shareholders generally do not owe taxes on stock dividends. However, types of questions we will see in various other lessons will involve the adjustment of your basis that you have in the corporation stock. So just keep that in mind. You're generally not going to owe taxes when you receive a stock dividend. If I have 10 shares of Apple, maybe Apple gives me another 10 shares as a dividend. Those shares are not immediately taxable, but it will affect my overall basis. So that's something to keep in mind. Shareholder inspection rights. As mentioned earlier, yes, you have the right to inspect the books. However, there are acceptable reasons to inspect the books. I can't walk up to Home Depot and say, I want to inspect the books. That's why these large corporations generally are going to have audited financial statements that they issue quarterly, annually. That is kind of the middle ground, the way for you as the shareholder to see how well the company is doing. However, if you had another reason, let's say you're a massive shareholder, right? You're a private equity firm, you want to do a little extra due diligence that maybe me or you as average Joes can't do. Shareholders have the right to inspect and copy the corporation's records, provided they have a proper purpose related to their rights as shareholders. They must give 5 days written notice, and they can send an attorney, accountant, or other agent to actually do the inspection because maybe you're not an expert in that field. The proper purpose requirement aims to protect the corporation from unwarranted or potentially harmful requests while ensuring that shareholders can exercise their right to protect their investments. So it's kind of trying to balance the rights and obligations on both sides. You don't want the corporation being inundated by every other day, someone wanting to come in and inspect the books. That would be a little too much to deal with. Here are some acceptable reasons for inspecting the books. If you want to investigate potential mismanagement or fraud, totally, that sounds fair to me. Shareholders may have a valid reason to inspect the corporation's records if they suspect that the company's management is involved in misconduct, fraud, or other actions that could harm the corporation and its shareholders. You could also do this to evaluate the financial performance of the company. Now, again, generally, are you going to be able to do this? No, you're going to have to say, just look at our audited financial statements, and that's what you're going to use to base your investment on. But these are the actual acceptable reasons per the rules for corporations. In terms of how these are actually done in the real world, we're not going to worry about that. Just memorize this from a textbook perspective. Shareholders may want to assess the company's financial health, profitability, and overall performance to make informed decisions about their investments. Assessing the value of their shares, shareholders may need to inspect the corporation's records to evaluate the value of their shares, especially if they're considering selling or transferring their shares. Reviewing corporate governance matters, shareholders may request access to records to assess the effectiveness of the board of directors and the overall governance of the corporation. And lastly, verifying the accuracy of financial statements, shareholders may want to inspect the company's books to confirm the accuracy of the financial statements and ensure that the corporation is providing accurate and timely information to its shareholders. So those are acceptable reasons. In practice, how is this going to work? What's the process? Don't worry about it. Just pretend like it's as simple as this in the real world. Now, here are unacceptable reasons, because we talked about acceptable reasons. They all made sense. But what would be some reasons to protect the company and not let people try to go in and check the books out whenever they want? Well, first off, personal gain unrelated to shareholder interests. Requests for inspection made for the purpose of personal gain or to obtain information that would not benefit the shareholders as a whole are typically deemed unacceptable. So the company, if someone wants to go in and look at the company's books and just kind of data scrape it, they get a lot of financial information for their own purposes. Maybe they want to sell it to someone else, corporate espionage, all that stuff. Yeah, that would not be an acceptable reason. Harassment or retaliation against the corporation. Shareholders may not use this right as a means of harassment, retaliation, or to pursue a vendetta against the corporation or its management. Basically, just continually pestering them to see the books in order to be a pain. Obtaining information for a competitor. Yeah, corporate espionage, that's no. We're not going to be allowed to inspect the books for another corporation. And then phishing expeditions. Shareholders may not request access to corporations' records without a specific valid purpose in mind, so such like the ones we saw on the previous slide. Requests made on a speculative basis, what you could call phishing expeditions to see what you can find, are generally not acceptable. Yeah, I just want to look through the books and see if I can find anything that looks odd or misleading. Nope, you need to have a specific purpose. Ultimately, acceptable reasons for inspecting these books and records are those that directly relate to the shareholders' interest in the corporation and its well-being. In contrast, unacceptable reasons tend to involve personal gain. So also with point one, the personal gain, if I want to personally go in and inspect the books to get just some more data on the industry as a whole, that's not benefiting the shareholders as a whole. So as such, that would be an unacceptable reason. Harassment, other motives unrelated to overall shareholder interests. Again, You as an individual shareholder, maybe it's in your interest, but is it in the best interest of all the shareholders? In which case you may be shut down. Corporate shareholder rights and actions. Here are some other rights and actions that we want to talk about. Preemptive rights. Well, preemptive rights refer to the rights of existing shareholders to purchase additional shares of stock when a corporation issues new shares. This is going to allow shareholders to maintain their proportional voting strength and ownership percentage in the company. So if a company doesn't like a certain shareholder, maybe an activist investor, someone who comes in, takes large chunks of companies, they buy 30% of the company and they start making demands. This is to prevent the corporation and management from diluting out that person. So if that person originally bought 30% of the outstanding common stock, this preemptive right allows that person to maintain their 30% share and buy additional shares that the company issues. Because if I am running a company and someone buys into my company that I don't want them to because they might start to making demands of the company, which is in their rights to do. That's totally within their rights. But a lot of management doesn't like that because, well, it changes to the structure and they just kind of like how the status quo is going. So activist investors could be positive forces, negative forces, but generally speaking, they're just out there for their own interest, makes them money on an investment. Now, this, again, allows people to maintain their ownership percentages in a company, doesn't allow the company to just print. It's kind of like money printing, right? Diluting, just creating a bunch of shares for the sake of kind of kicking someone out. Now, under common law, these rights were automatically granted to shareholders. However, under the RMBCA, which, again, don't really worry about that too much, this just has a lot of legislation about corporations. This actually states that preemptive rights only exist if they are explicitly provided for in the corporation's articles of incorporation. So if you want to know if you have this right, it actually is going to be in the articles of incorporation. So not necessarily every company is going to have this right. Shareholder derivative action. This is a legal action brought by shareholders on behalf of the corporation when the corporation itself refuses to take legal action against someone, so for example, directors or outsiders, so insiders or outsiders of the company. These actions are taken to enforce the corporation's rights and protects its interests and are only applicable to cases involving wrongs committed against the corporation. And lastly, here we have direct versus derivative actions. If a shareholder seeks to enforce their own rights against the corporation, they're going to have to file a direct action, and that's not a derivative action. A derivative action is reserved for situations where the corporation's rights are being vindicated, whereas a direct action is for an individual shareholder rights. These are kind of just general things to know, not like you're going to be tested on these exactly, but just kind of paint a picture of what your rights are within an organization. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.